Namaskar Mandali, this is Madhav, and we are part of today's program is organized by Chaitanya, and, and obviously it is part of the investment group. So, what is the cost of investment activity? And the investment activity leads to transactions, meaning you buy and sell. And once you do that successfully, you make profit, which is called capital gains. And then how the capital gains is taxed, which is, so what is my net income? That is the question lingering in our mind. So that is so far investment activity is concerned. And the next thing that we will try and discuss, we all have our origin back home, and therefore I have some investment property income back home, how that is taxed there versus that is taxed here, what are the tax credits, and I want, for my investment activity here, I want to bring in some money. When should I bring it? And if I bring it, what are the advantages and disadvantages of that? So we will see, and if we can discuss these things within next 15 to 20 minutes. आताच आपण सगळ्यांनी मराठी नाटक पाहिल्यामुळे ऑब्विसली वी हॅव अ डिफरंट त्याचा माहोल तयार आहे आणि देअरफोर आपल्या डोक्यामध्ये विचार वेगळे चालू आहेत. सो विल कीप इट जस्ट दिस important issues, important topics. Okay, so primarily, let's see. Taxes are a necessary evil of democracy. When we have to run democratically, it has cost, and the cost has to obviously shared by all of us. How to share this cost? Proportionately, depending upon what activities we do within this democratic world. And therefore, it has to do with higher income, the bigger shoulders should bear the bigger burden. That is the way the tax structure or the tax step-by-step tax rate schedules are governed. So, federal taxes pay for the federal government expenses, state taxes pay for the state taxes expenses. Now, why is there a state tax? And that's a politics. When all the states got together, they preserved their right to raise taxes. And just to exercise that, they have their own tax structure, own formalities of filing tax returns, and they draw most of the information from the federal tax returns, so that it's not duplicated. Can this be ever avoided? And there is always a discussion going on how to simplify this complicated structure and why duplicate it. And there is a cost to run all these departments unnecessarily. So one suggestion always is very simple. To the federal tax return, can we just add one small line for each state? Select the state of your residency, add 10% tax to that. Whatever you pay federal, that tax allocate, let 10% go to the state and 90% go to the central. And then avoid all the state tax forms, audits and everything. Can this be done? In principle, yes, everyone wants that this should be done. There is a concurrent opinion about it. However, politics and jobs, so it has not worked, remember. So you have to understand that that's how the tax structure has tremendous politics built in. So does truly stronger, broader shoulders pay their share of the taxes? And the answer is, there are smart politicians, they call themselves smart, and they pay only $250 in last 2 years. And that's why they are very smart. What is that smartness? It's very simple. While they are making money on the right side, they make sure that they have enough losses on the left side, at least the book losses, and that book losses will mitigate some of their taxable income. So that is what we are going to discuss today. That smartness, we are going to think about it in our investment activity. When we are doing investment activity, we are obviously doing transactions. We are making, with each transaction, we make either profit or loss. And we make a lot of net. The idea is to make a lot of net gains, but these gains are taxable. So is there any way of avoiding it? And answer is, can you make some of the investment holding that you have and you know they are not profitable, your hands are tied up in that investment. There's a lot of money locked up. Is there any way to free it with some concession? And what is the concession? The concession is tax. When there are huge profits, some of the investment that you want to get out of it, that they will not finally ever make money, this is the time to get out of that, meaning make losses. Make losses, and that way save some taxes. That's all is the tax strategy in investment, making losses. And when is it convenient to make those losses? And there is one simple way of a note of caution. IRS does not like people making losses in the month of December. People by that time, in the month of December, look at their tax structure, which is called tax planning, and see how much tax they will have to pay this year. And then what happens is that, can I make some losses? Some smart people during those 30 days of December sell some of their investments and make losses, but they like those investments, and that price now it has gone down. That is a good price. What do you think they do? Come January, they rebuy it. That's exactly what IRS doesn't like. This is called excludable losses and disallowed losses. And what the IRS ruling is, 30 days before 31st December and 30 days after 31st December, if you have sold and bought back the same stocks, similar cost, and you have reinstated yourself where you were before 31st December, that loss will be excludable, not deductible. So this is the one thing you have to understand. While you are making transactions, you will see a lot of activity happening close to December. And one thing that you need to avoid, that such activity that 30 days after that, you make sure that you don't buy back the same stocks in next 30 days. Otherwise, those losses will be excludable. They are excluded. Okay. Now, another thing about taxes that you have to understand is taxes never go away. It's a very, very important thing to understand, that taxes do not go away, or the correct word is they never die. What does that mean? That means that a lot of people, when they have a lot of loans and tax burdens, they file for bankruptcy. So government has, and the tax structure has, or legally, there is a way out for such a person. You can negotiate all your loans on one date, all your loan burden, negotiate with all the lenders, and come up with a way to satisfy that as much as you can. So you give them 20 cents in a dollar, let's say, if whatever assets you have, just add up your assets and give up those assets and mitigate all the debts. And then it is called, legally it is called starting afresh with a clean state. So you can start your life just so there is a way to escape from unfortunate events. But does bankruptcy also is a way out of taxes? And answer is no. Taxes get stalled. They wait outside. I'm talking about income tax, remember. I'm talking just the income tax part. And they are waiting outside for you to make your first dollar with the clean state. When you do that, taxes come back and they try and recover their backlogs. So taxes never die. Very important. Now, what happens? In fact, if you die, does taxes go away? Same answer. They don't go away, but they look at all your remaining estate, remaining assets that you have left for your beneficiaries. Taxes are in between that. And they will take away their share, and the net is distributable to the beneficiaries. So in short, taxes never go away. That you have to understand. So the best thing is to the best way at the least cost, make sure that you deal with it on a regular basis, because they will otherwise haunt you. So it's very, very important to understand about the taxes, that they never go away. Now, what are these taxes anyway? So we will just look at our investment activity. Is that investment activity realizes that either you buy and sell within a year. If you buy and sell the same investment within a year, it makes a short-term gain, short-term capital gain. And if you were holding that investment for longer than a year and then sell, your realized loss is called long-term capital gains. And they both have a different tax schedule. They're taxed at different rate. More or less, a short-term tax returns, all the capital gains are reported on Schedule D of your tax return. The first part is the short-term capital gains reported. On the second part is the long-term capital gains reported. Short-term capital gains structured and their basis is more close to your regular earned income structure. So they are taxed like an earned income, more or less by the same rates. And the capital gains, however, the long-term gains, however, I'm just talking about for the single taxpayer, and there are little different schedules for single, married filing jointly, and married filing separately, etc., etc. So a long term are like for $40,000 is zero tax rate. $40,000 to $441,000 are taxed at 15%, and anything over and above 441,000 are taxed at 20%. So these things are taxed differently. You have to remember. There is one situation. This is extremely important that you all understand. There is one situation. If the short-term capital gains are taxed at the individual tax rate, meaning the lower tax rate, and if you have no income in that year, let's say it just happens that you have not earned any income, no taxable income, except the remaining assets you sold them for whatever reason you're moving out, and you made some short-term capital gain. Then if your earned income is taxed at 0%, your short-term capital gains during that year will be also taxed at 0%. You have to remember that. So there is one small way out, which is the last day. And that presuming that you have no other taxable income or transaction in that year, etc., etc. Now, generally, you have to understand what is how the taxes rates, what they look at it at. So tax are considered, the tax policy is considered as economic governance, meaning the way that they want the government want economy to move in the same direction. So they encourage you to move into that direction. So the tax structure gives you special benefits for moving into that direction. So there are economic consideration and social considerations. Let's look at the interesting part is the social consideration. Look at it that if you are a single person, you're taxed at the highest rate. So you have to understand that tax structure almost motivates for you to get married. The lowest tax rate schedule is for the people filing married file jointly. If you are separated and you decide to pay your separate taxes, married file separately, they are taxed at the highest rate. So very interesting that the tax structure favors marriages and staying together. Very, very interesting. And having children, so that there is more and more people are educated, they are brought up, and then slowly they start earning and start paying taxes. So it's all is a social structure, and the social structure favors marrying, having children, sending them to school. So if you have a dependent children, which means there is a special allowance given for you in the tax structure. If those dependents go to the school and now you have schooling expenses for qualified graduate courses. So higher education is promoted by the tax structure. You have special credits for that. This is what you have to understand. Extremely important that very rarely people understand that it is favorable to marry, stay within marriage. I'm saying all these things, a couple of more loudly is because I'm very old. You have to understand that. I'm also favoring that anyway. So that is a very, very important thing. Second thing is economics. Economic growth is. So therefore tax structures will tell you, sometimes you will see these notices on the road, there is a road construction going on, repairs. And on the top it says, your tax money is working here. The idea is that when you live in that locality and you see some development, and this has become possible because of your tax structure, that's a motivation for you to keep paying correct taxes. Please pay accurate, correct, minimum burden, calculate it properly, but share your own burden because it takes care of social costs and social maintenance. This is extremely important. Now, let us see that the current year, we have some very, very interesting new situations. And the new situations are like this. Government has suddenly called impact checks and put money into our pockets. A lot of us have received the first check of $1,200 and the second check of $600, $1,800 into our pocket during 2020. Impact help from the government. Now, the tax structure now has taken care of that, and for everybody. So this is what this year's taxes. While you're doing your this year's taxes, you have to remember that each one of us will have a credit of $1,800 into their tax return. This is a refundable credit. 1200 plus 600. For the couple will have 1800 plus 1800. So this is the refundable credit in each 1040 that we will see. That needs to be adjusted with the actual money that we received. So let's say if we received a check of $600, reduce your credit by $600 and then get the net credit, claim it in your tax return. Again, refundable credit. So this is a new thing this year. Now, this has come very crucially, the last minute arrangement, and IRS doesn't know how to have a different type of reporting forms for this. So we all have a question, is like, when did I receive and how much money I received? I don't exactly remember. I didn't receive the full check, but I received partial check, and I received only one check. Is there any way of checking that? IRS has on their site, IRS, the official site, they have a special section where you can check that. Okay, so you can claim exact amount that you received against this credit. A lot of people now have another issue that has come up. Some people have received one check in 2020 and a second check in 2021 early in the month of January. And where a cash paying tax 1040 is filed always on a cash basis. Now, when do I say that I received the money? Is it received in 2020, comes out of 2020 credit, or 2020? I have to report that in 2021. Great thing is today IRS doesn't have enough personnel to answer this question. Nobody has a correct guidelines for that. Your best bet is whatever is the best for you, you do it. If you, for whatever reason, do not claim a proper credit, remember that you have that money with you, and sometimes when IRS catches it, you will have to repay that. But I don't know if IRS hands are so tied up these days. The full force, they are not working, and therefore they don't have a proper recording of these things. So everyone has to solve his question by whatever he feels is convenient for himself. That's fine. Don't quote me the word convenience. I don't mean convenience, comfortable, whatever that you feel comfortable, try and get out of this situation. But remember to make sure that you have these credits in your tax return. Extremely important. Now, this credit gets, of course, get reduced by your income level. And the income levels are $75,000 for individual, $150,000 for married filing jointly. And you have already received that calculated money accordingly. So you have those amounts with you. Perfectly fine. Now there's another thing for the current year that you have to remember. Now that if you are filing business tax returns, the filing date for the tax return was March 15th, usual rate. And individual tax return 1040 filing date is April 15th. If you are expecting refund, don't wait all this time. Just file it right away because it's done by the computers, and tax returns, refunds always mailed to you in your bank. So make use of that always. Don't ever get that confusion. Okay.
Kaka, I have a question. So
Yeah, go ahead.
is this only for California or all states? The 3 months extension by default. It's national?
Federal taxes is a national. And the state, you will have to go to each state for individual taxes. I think 6 or 7 states has not yet followed with others. There's a list. If you go on IRS, Google, just Google it for your state and say that has state extended following the IRS ruling, and you will see there are 6 or 7 states still not have approved it.
Okay, thank you. Kaka. Moini, I wanted for Oregon actually. Me California आणि Oregon बघत होती. तर Oregon मध्ये extension आहे की
We'll have to Google it.
Okay, thank you.
If you, and you can always such um, clarification questions you can ask me anytime. You can send me an email. You can send the email to Chaitanya, and Chaitanya will forward it to me, and I can Google and give you a reconfirmation. Okay.
Perfect. Thank you, Kaka.
No problem. No problem. So that is another thing that needs to be remembered this time. There's a little speciality. And also on your W4, I'm sorry, W2, you will see that there are some extra entries and special alphabets codes used in box number 14. And usually those are pandemic sickness leave paid by your employer. And as a special case, because they received funding from the government, and then whoever was, if somebody is quarantined in your house, you are not allowed to come to the office, but the office will pay you for that. And that payment was considered as special payments. And you have to remember that anything that is given in box number 14 is not separately taxable. It is already included in box 1. This is just a special explanations given to you. And sometimes there could be some credit computation because of that, but that is different. But this time special considerations are special payments made for the pandemic reasons. So I'm just going to emphasize on what is the specialty this year, and then the general questions also. Okay, so remember that. Look up for in your W2 box 14, and there'll be some special information given there, because your employer received the help, and when he passed it on to you, he's required to give you details of that help. All right. So that's about it. Similarly, another very important issue this year is 401k withdrawals. Extremely important.
काका माझा त्याच्यात एक क्वेश्चन आहे. चैतन्य बोलतोय. तर तुम्ही म्हणला की ते जे पेमेंट दिलेलं आयरसने ते कॅल्क्युलेटेड ऑन द इन्कम लेवल, जर पण टॅक्स फायलिंग नसलं तर त्यांनी लास्ट इयर इन्कम लेवल कन्सिडर केलेली आहे, तर मग रिकॅल्क्युलेट करावं लागणार का की ते ऍक्च्युअल टॅक्स क्रेडिट होतं किंवा नाही? डिफरन्स असला इन्कम मध्ये 2019च्या लेवलने त्यांनी पेमेंट केलेलं आहे आणि 20 मध्ये तुमचं इन्कम वाढलेलं आहे किंवा काही चेंज आहे, त्यामुळे अमाउंट शुड बी डिफरंट. शुड यू recalculate credit or you use the same?
You're talking about the credit, right?
Yes, credit.
The credit is a flat given to you at the moment. The credit given is 1,200 and 600, 1,800 given to everybody.
Yes.
There's no calculation. The calculation is for the money that you have received, and the answer is yes. You can go to IRS site, recalculate and claim the difference if you think you should be getting slightly more, and IRS will send you a check for that. That is correct. So if you had not filed a 2019 tax return when the calculations were made, and once you file the tax return, it transfers now that you are entitled to a slightly higher refund check, you can claim it by going on the site. You have to just open your account, pay in your social security number, and claim it. Simple. And then obviously your on the 2020 credit will get reduced by that amount, of course, accordingly. And that's exactly what I said, that IRS, if all this happens after you have filed the tax return, is IRS going to make the correction? Do they have a manpower, etc.? That's why I said, I don't know. It's your comfort level. Just if you have some small amount from IRS that is with you and you should be refunding it to them, hold it with that understanding. If ever they will eventually come to it, they will ask for it. Otherwise, enjoy it.
Okay, thank you.
No problem. Okay. Now, we will discuss one important issue very quickly, and that is provident retirement money. This year, a lot of us were required to withdraw money from our retirement funds, 401k, IRA, Roth IRA, etc. And all of them have a 10% quality penalty requirement. If you withdraw before they were not before retirement, right? 50 and a half years and 70 and a half years, and there are conditions and calculations, etc., for tax purposes. IRS has withdrawn that penalty, so there is no 10% penalty this year, and therefore you have received a large amount. Now your question is, if you report all that money into 2020 tax return, suddenly there is a large increase in your income, and therefore there will be a lot of income tax payable. IRS given a special directive to that. You, at your convenience, if you want, you can report only 1/3 of that money this year, 1/3 in 2021 and 1/3 in 2022. So you are allowed to withdraw and report in installment. Very, very important. Okay. IRS forms do not have a special arrangement to disclose it yet. So you just disclose this, that you are reporting only 1/3 this year into the description. Let's say Joshua 401k account dash 1/3 reported, so that at least you are covered, you know what you have done and what you are required to do next year, that you will remember it by looking at it. Extremely important. Now, IRS has now come up with another benefit to us people, because this is a retirement money and you don't want to use it in this all used up retired money into these difficult times. And during next 3 years, if you will have enough savings, IRS says that you can repay this money back into your retirement money. So talk to your retirement administrator, employer, or whoever it is. And during 2021, 22, and 23, within these 3 years, as and when possible, and whatever is possible, you up to 100% of the loan, you can convert that distribution into loan and start repaying into your retirement fund, so that it will reinstate your retirement. And then at that year end, let's say in 2021, you are able to put in one-third money, and you have claimed 1/3 money, you have already entered into your tax return, 2020 tax return, and paid taxes on that. IRS guidelines say go and amend that 220 tax return, and because you have redeposited that money into tax deferred funds, claim a refund on that. So this is very, very important. You will require to amend all your 3 tax returns as and when and how, the amount that you are repaying into your retirement money and securing your retirement. Now you have to understand why IRS does this very carefully, is that they want more and more people like you to have their own retirement dependent fund, so that fewer people depend on Social Security. This is very, very critical for IRS and for all of us socially, that the money that you have received without penalty, try and put it back into your retirement and reinstate your retirement, because that will help you when you retire. Extremely important. All this means there's an added cost to amend the last year's tax return to 2020, 2021, and get that money back, etc. You know, I can truly go on like this, but it is already 12:11. So I'm just going to give you some very interesting modern things that we can look up in the future and then close it down quickly. So I'll just spend the next 2 minutes into the new things. This year, some softwares, very interestingly, the computers are taking us to the simplicity. There are some softwares that when you buy the full price, I mean, it is slightly expensive, that's why I'm using full price. They give you they allow you to download an app onto your cell phone. Very interesting. Then through that app, all your documents, you can actually take a photograph and upload into the software. So if you have two W-2s, 1099 interest, dividend, and etc., 1098 mortgages, etc., you can just all IRS forms, take a photocopy, upload into the software, and they're entered and your tax return is ready. Your job is only to review it and finalize it. And that is the new thing that you will expect each year happening to all of us soon. That's where the softwares are taking tax preparation. Okay, it's going to be very, very slowly, very, very simple thing. And lastly, a simple joke, that I learned over the taxes and softwares. When the softwares initially were done, I was preparing tax return for my client. One of the spouse had died during the year. When the spouse dies during the year, that year you are allowed to file the tax return jointly, because you had no warning and time to prepare for a separate income and tax returns. So you file the last joint tax return. So I prepared the tax return into the software and e-filed it. This was the initial first 2 years, and the softwares were not giving you enough directives. Guess what? IRS would reject that return. This happened 10 times, and I had done everything correctly. And finally, I called IRS, software and IRS. Guess what IRS told me? When somebody dies, the address has to be care of. A dead person does not have an address. Understand this very carefully. This is now philosophy. A dead body cannot have address. Just add in the software, just add 2 small letters, C/O, then write the address, and the tax return get processed, accepted. This is very, very interesting to understand philosophically. Try and think that it's the care of address. You cannot mail a letter to a dead person. I was shocked. I was shocked to see this reality into tax laws. Enjoy it, guys. If you have any questions, anytime, send a small email to Chaitanya. He will forward it to me. And remember, I'm a retired person, so I won't be able to help you actually tax preparation, but I can give you a lot of clarification. Thank you so much. Thank you, Chaitanya. Thank you, Sanjeev. Bye-bye.
Thank you, everyone. Thank you, Kaka. Any questions?
Thank you, Kaka.
Hello, namaskar. Me Prashant बोलते हैं. A quick question. Namaskar, Madhav.
Namaskar.
Quick question. Maybe if you can tell a little bit more about the tax implications and real estate developments. I mean, what is taxable, what is not when you actually buy, sell properties and so on.
Sure. Real estate now is other than, just buying and selling real estate. Some people are interested and they buy and sell real estate. And then it is like any other capital investment. So like stock, for example, you buy and sell it. However, when you hold it, the land appreciates. Item one, and it is there physically, it is there. So other than land, but the building depreciates. So people have another activity in between is that you can rent that building or even land and make money in addition to its appreciation. So you have there is some rental activity while you're holding it. And that is the difference between other investment and real estate investment, is that it can fetch you additional income in addition to appreciation. So anything that happens due to appreciation is capital gains. Whereas anything done by the rental activity is called passive income. Very important. You have to understand that is that rental activity is a passive income, that you are not doing anything actively there other than the maintenance or gathering the interest, gathering the rent. And then there is a depreciation expense that you claim. As a result, you have to keep adjusting the cost basis of the purchase before when you sell it. Now, when you sell the property which was rented out and a depreciation claimed, during the sale process, you have to recapture the depreciation. So you don't have advantage twice. So IRS asks you to recap all the depreciation expense claimed, and that is again treated as a capital gains. So you have to understand that although the value has gone down, there is a depreciation recapture, and that is added to your capital gains. Now, in addition to this, you have to understand rental property is a rental income or a passive income, and it is taxed differently. Meaning that it is taxed as earned income. However, if your other income is adjusted gross income is $150,000, then your rental losses gets deferred. You cannot claim them. So there are some people who, as we just said, the smart people who like to make losses. They have rental property and keep making losses so that they can reduce their passive losses, will reduce their active income and reduce the income tax. However, if they are rich people, the passive losses get suspended until the activity is you stop that, until you sell that, stop renting activity. So these are the various nuances within that. They are not very complicated, but you have to. It requires a different kind of mind to understand that. That's it. Just get used to it. I hope Prashant, have I answered your question?
Thanks. Yeah, thank you.
Thank you.
दुसरा क्वेश्चन आहे इंडिया इन्कम बद्दल. काही लोकांचे इन्व्हेस्टमेंट असतात किंवा इंटरेस्ट इन्कम असतो इंडियामध्ये, तर त्यासाठी टॅक्स इम्प्लिमेंटेशन काय आहे आणि हाऊ इट कॅन बी मिनिमाइज?
Sure. You have to understand that the income tax law apply to our body. Very important. The joke that we just shared. Meaning, it depends on your residency. Where are you your residency determines which tax laws apply to your investment and activity. Now that let's just presume that we all are US residents, and therefore we file normal 1040. The letter after 1040 is R, meaning a resident tax return, which is 1040 normal. A non-resident will file an NR tax return, and the different types of laws apply, meaning they don't have, non-residents do not have any deductions, basically. Now, if we have property in India, or if we have, let's say, bank accounts and stocks, then we have interest, dividend, and rental income as a non-resident in India, and it will be taxed there. So you will pay Indian taxes there. Luckily, India and America have tax strategy agreement. Okay, and therefore that avoids duplicate taxes, meaning that as a resident of United States, your global income is taxed on 1040 and you pay income tax on that. So you report your regular US income first, then your non-resident world income, You add interest to interest, dividends to dividend, and rents to rental activity income. Add it as a non-resident income. Non-resident income will be then added to the normal income and taxed accordingly. There's actually a regular tax. Once that happens, however, you have the same amounts have been already taxed in India. So there are two requirements. One thing is the reporting. There are also separate additional reporting forms required, your bank accounts and etc. etc. And then Indian tax, if you bring the proof, keep the proof in your documentation, and you get credit for like any other taxes paid. Like total tax, less taxes, American taxes paid, and together with taxes paid into other non-resident countries' taxes. This is because of the contract between a special treaty between India and America. As a result of the treaty, you get credit for the taxes paid. Now, you have to understand that credit, although reduces tax, it is not refundable. You have to understand it is not non-refundable credit, but the unused credit gets transferred to the next years to be used. And why it is not refundable? Because the money is with Indian government. So American government will not give you any refund on that, but they will reduce the tax. That's about it. And the reporting of the bank accounts and investments is done on a separate form. The reason for that is really, really different. It all began with the illegal activities supporting through your banks. And that's why your banks, more than certain amount of balance, your bank name, account numbers, and addresses need to be reported to a different department in US Treasury, in addition to 1040. That's it, two different requirements.
Any way to minimize that means, or you report and that's it?
No, you report and tax it. There's no way of minimizing that. Actually, there is other way around, is that if you have even a simple bank account or a bank deposit in Indian banks, they pay you 7.5% interest rate. There is no such interest paid by American banks. So, if you have excess money that you don't need it here, and if you know how to manage it back home, you can keep it there by simply because that the interest rates are higher and there is no double taxation anyway. And even there is I think, and don't quote me, but the interest up to 300,000 bank interest is tax-free. As much as 300,000 interest is interest tax-free. So there's no so you have a 7.5% interest, but there's no tax to begin with. Initially, there's a larger tax cuts there, meaning those banks and that tax structure wants you to keep money there. All NRI people, they want them to keep your money here at that rate because we are not going to tax you there separately. So it is advantageous to keep that money there.
But if you're not paying tax there, it will be taxed here, right?
Of course. But that's just one. You have to pay one tax always. There's no double taxes. That's all that means. Meaning if the tax rate back home was higher, and then it's taxed at that rate as against this rate, then we will compare the two things differently.
Okay. Yeah. Thank you.
Thank you. Thank you. So look out for the emails if there are any other special issues. For example, there is one issue that generally, let me just give you a small quick trick. A lot of people say that I have inherited a large apartment back home and I want to sell it. But what is my cost basis and when do I sell it? And the answer to that is very simple, is that there is a date some 10 years back, and you can just follow the market 10 years back and pick up that date as your cost basis, not ancestral property bought by 2 generations back. Okay, So that is not the cost basis. Cost basis is just about 10 years back, and there is such a date, and you need some Indian chartered accountant or a lawyer to tell you that exact date, and also a real estate agent to find out what was the cost basis, market rate on that date. So that will be your cost basis. I have, and I'm just sharing, don't quote me, you have to go to a good attorney back home. And I have learned a small trick. When your parents left an apartment or a real estate for you, they were at that time they were interested in grandchildren and their education. So therefore, they had put a small condition that you cannot sell this property until grandchildren's education is completed. Because they were worried that what if you have to come back to India and then send them to the school here, you should have a small apartment here, something like that. And they, Mickey Mouse, they just come up with some small story and put a small condition. And when your child became some 25 years of age, then that property became sellable and you could sell it. So on that day, it become your cost basis is on that day, market price on that day, not from when your father passed away and left the property. But during that time, to your son becoming coming off the age 25, you had a condition, you didn't have a right to sell, and there is a small piece of paper that they draft and put it under your pillow. That's it. IRS doesn't follow that up. But you can choose a market rate, make a capital gain, bring the money here and pay the capital gains tax. That's it. That's fine. Thank you. But this is a trick. Don't quote me. You can investigate yourself. This is not law. This is the way it is practiced back home.
Okay.
That's about it. So Jai Hind, and all kinds of emails are welcome. Thank you.
Thank you everyone. ईमेल पाठवा तुमचे काय क्वेश्चन असले तर आणि नेक्स्ट सेशनला आपण परत भेटू. धन्यवाद.
Thank you, Chaitanya.
Thank you, Kaka.
Thank you, Madhav.
Thank you, Kaka. Thank you, Chaitanya.
Thank you. Thank you. Bye-bye.
Welcome.
Thank you.